Good morning, ladies and gentlemen. Well, the risk dial is completely stuck at 83, which is a very high reading. If we have a look at what happened last week, well, absolutely nothing. Really stuck at 83 throughout. We have no signs of any kind of risk-off thrust. We've been in risk on for now over a year, since July of last year, and the market just keeps on trundling higher. These moving averages are absolutely bunching up, and at some stage we will get some sort of a risk-off thrust, but it doesn't look like it's imminent. And really there is no alternative to equities and as an asset class, and we shall look at all the reasons for it. But first of all, as always, we take our clues, immediate clues, from what the bond market is doing. Very little change in 2s 10s. We started the week exactly where we finished the week, within a basis point. We are now back to where we started the year, at around 100 basis points, 99, 98, whatever you like to call it. But it's very significant to me that we are just going sideways here. We are going to get a movement off this line at some stage. Either we break down or we continue higher. But for the time being, I see absolutely no sign that anything is happening. I still think that Jackson Hole in about 3 weeks' time is going to be significant. And that is when we are going to get the movement away from this line, one way or another. But I think we still have another couple of weeks of just faffing around between this level, 116, 117 basis points, and 98, something like that. I really can't see any reason for movement for the time being. The Fed will decide on its stance about the tapering, and when the market might start pricing in some rate hikes. I still think rate hikes are likely towards the end of 2022, and tapering, I think, should be very, very quick and end Q1, Q2 of next year. That to me would be a movement which actually flattens the yield curve, and the yield curve eventually goes down to the 75 area. That is my preference, but we will look at it week by week and see what the market is actually telling us. Almost no movement in every single other part of the yield curve. This is the 5s, 10s. As you can see, basically it's doing another one of these. The big resistance is going to be at 47, 48 basis points. We are basically stuck within 1 or 2 basis points movement per week, which just shows you that there is absolutely nothing going on. The really important one, 5s, 30s, is now stuck between 124 basis points, which is the swing level, and 105, 109 basis points on the upside. As long as it can't break 105 basis points on the upside, I see very little further flattening in the immediate time frame. I think it's as it is, we are going to be in this area between now and Jackson Hole. And Jackson Hole will then decide whether we steepen or whether we flatten. And that will be the seminal moment that we can now point to. In the meantime, I think the market is telling us that it's on holiday. Bonds are always fairly quiet in August, and unless something very major happens, the yield curve is asleep. With the yield curve asleep, you would expect the individual tenures to be doing very little and having very little movement, and that is precisely what's happening here. Fives, we are stuck basically with the 200-day moving average coming up. I think it's going to be very, very difficult, and I see no reason for it to break this area around 65, 67 basis points. And really the upper band is going to be here around the 80 to 82 basis points mark. I see very, very little reason why we should break these levels, and we will be trading somewhere between them. If we go to the 10s, we see much the same kind of pattern. We enlarge this box. We are stuck around the 200-day moving average. These tenures of the 10s and the 30s are looking actually more bearish in terms of yield than the 5s and the 2s. Really, I would expect over the next couple of weeks a range that holds the 200-day moving average until we see Jackson Hole. The 30s, much the same. I really cannot see that we are going to be more than 5 to 10 basis points away from this very pivotal 190 basis points. The 200-day moving average is still going up towards 2005, 2%, but it's very unconvincing. This move was much more convincing to me. The market is basically saying that the economy is weaker than the Fed expects, and that any kind of hikes are going to suppress inflation and actually turn the economy towards an underperformance. We have borrowed from the future as much as we can. And we are very, very unlikely to be able to grow faster than trend over the next, whatever it happens to be, year, 2 years. And that is, basically what the longer tenures are saying. There is absolutely not much chance, if the Fed changes its stance, of the economy growing. And basically 30 years are at the moment stuck between 180 and 2, waiting for the Fed decision. The situation in Europe is actually not very different from the situation in the US. The ECB is very, very easy. This is the bubble. It's coming up to very, very important levels here around the minus 76 area. I think there's very little reason for it to go through, simply because the market will be afraid of what happens at Jackson Hole. I am slightly short of bubble futures. I think the odds are, as you can see, this is what happened during the absolute panic that we had about coronavirus, and really never have we really traded much below minus 83. So this kind of level, which is 7 basis points away from the absolute bottom that we had when we were trading as opposed to panicking, to me represents some value for a return of not much. I mean, I'm looking to go back into the 60s. So it's not a big move. We do have a lot of issuance next week. So I think the risk reward for next week is to be slightly short of bubble futures and look for this kind of level, minus 68, minus 69 to get out. It's not a big move, 5 basis points, but it's probably something worth doing. I've done it in very small. As you can see also, this is the Bund. In the Bund, we are at a very, very important level. This minus 47, 48 level. I think it's more likely to go to minus 38 than not. So that is what I'm playing for. but also Europe, I think, is going to be in a range for the next 2 or 3 weeks. At some stage, the markets will start pricing in some fear of what happens in Jackson Hole. And that's why I think that when Jackson Hole comes about, we will be somewhere around this minus 37, minus 38 basis points. France and Italy, I think France is actually clearer, a very clear ABC down, filled all the gaps, and now we are at these levels which were very pivotal, as you can see here and here. I think it's more likely to go down up towards zero than basically bust through minus 22. And Italy as well is giving me an idea that we are bottoming in terms of yields and that we're more likely to go to this minus 76, minus 77 area than we are to bust through the previous lows. What to say about the US dollar, which I haven't said before? It's a real bitch to trade. Given that it's in a range, and it's quite obvious that it's in a range because it never busts an important level. For a couple of weeks I've been saying 93.14, it has to break and close above there for it to get into any kind of a trend. It gets to 93.14, rejects, comes right back into the range. Now the levels to look at are basically on the dailies, and it's this 91.41 area. I shall enlarge that so you can see it. I think it's very clear that 91.41 becomes our swing level, and really it becomes a better buy at 91.41 than not. At some stage, again, the market will anticipate the Fed doing something at Jackson Hole and will take the dollar up just in case. I would expect Jackson Hole to have the dollar around 92.50. So any kind of a dip down here to 91.41, I will be a better buyer, but that does not mean I will be very aggressive. This does fit in with Euro USD for a move up to 119.88.90, being a better sell than a buy. On a weekly basis, that corresponds to 120.11. So whether it's 119.88 or 120.11, I mean, basically, who cares? That's the kind of level that you want to resell it at, looking to go into Jackson Hole somewhere around 118, that kind of area, just in case the Fed does something. But it's in a trading range. Trade it. It definitely is not a positioning market. And that also says that the differentials between Europe in terms of yield and the States are going to be roughly constant. So if you expect it's saying don't expect a big move in European yields relative to US yields, it just isn't going to happen. Just like bonds are in a trading range and the dollar is in a trading range, so is gold. I mean, last week was absolutely classic, right? It gets up to 1830, 1830s, where I say resistances between 1830 and 1850. Don't want to know about it there unless it breaks. What do? We get everyone bullsed up in the 1830s, smack back down to 1817. I think it's very likely that we continue to meander. I would have thought that we, in a couple of weeks' time, we will be within 1% or 2% of 1800. I think it's more likely to come down than go up, simply because the fear is going to be that the Fed does announce some kind of a bearish for yields and bullish for US dollar kind of package at Jackson Hole, which will make people take it down, back down towards 1764 or closer down to 1764, just in case it's bearish. Don't expect the market to be at the most bulled up levels at 1900 when they could potentially get slapped with something bearish. So it's unreasonable to expect gold to make a move over the next couple of weeks, which is not consistent with bond yields and not consistent with the level of the US dollar. In terms of asset class spreads, gold is really not doing very much wrong. It's still nicely above this 2162 level against bonds, suggesting that gold is a better buy than bonds at the moment. But it's right near the highs against SPY, suggesting that SPY is still the better alternative to gold. Unless we see it below 236, you've got to keep on saying that gold is going to be weaker than equities, and unless we see it below 2162, you've got to say that it's going to be a better hold than bonds. It's right back in the middle between the two asset classes, saying that it's unlikely to change for the time being. I did think that gold had a chance to go to the center of the butterfly between the three. It hasn't taken it. It's gone right back to where it was before, which tells me that we are in a boring trading range for at least another 2-3 weeks until the Fed does something and tells the market what it is. Gold against all equities as opposed to just SPY is, can it bust through? Can ACWI start outperforming gold? This very important level around 61.93 where we had the previous tops. As you can see, equities are still carving out a more bullish pattern. I think it's much more likely that at some stage we accelerate through this, saying that equities are still the better asset class. And I think your signal is going to be busting through 61.93, that then equities will accelerate away from gold. For the time being, I think it's unlikely to happen in the next couple of weeks. Any kind of dip towards this kind of level is going to be my signal to take away money from gold and put it into world equities. The market keeps on saying, as it has been saying for quite some time, that DBC is a much better long than gold. It keeps on not being able to go below 1868, 1841. And on the weeklies, you can see the Bollinger Bands are nicely expanding. It just is saying that it's a much better alternative to gold. And if you have a look at this, is SPY over DBC. So the more it goes down, DBC performs better than even SPY. It's at the moment in a clear downtrend. Do I expect it to change very much? No, but I also expect over the next couple of weeks that it will continue, that gold just will not be able to be better than commodities in general. And if that is the case, if commodities in general are strong, then you certainly wouldn't expect a complete breakdown in bond yields, and you certainly wouldn't expect the equity market to tank. Because why? Because if commodities are strong, all this talk about coronavirus and 4th, 5th, 6th, 200th wave, whatever it is just rubbish. The market is saying that it doesn't believe that the economies will be closed down again, and it doesn't believe that the economic surprises are going to be that much worse than people at the moment anticipate. That is why DBC continues to be strong, and if DBC continues to be stronger than equities, that means that there is some inflation at the end of the road. So it's a much better long than gold, and also it's telling you that equities are unlikely to get hit very hard anytime soon. The US market is very, very clear. 43.88, as long as it keeps on closing above 43.88, that is our first level. There is absolutely no reason for any kind of a panic, and this is on the 195-minute chart. If we have a look at the dailies to see what that level is on the dailies, that is even clearer from this chart, which I can now enlarge and show you exactly what is going on the dailies. It is very, very clear. There will be no deep move down in equities unless we close a day below 43.8463. These levels are now very clear. We have been trapped for a whole week between those levels. Every time we dip below it, we go straight back above it. Complete indecision at this level, which is normal during a time of A, the market being quite fully valued, and B, having earnings, because you get huge moves in individual stocks, and especially big individual stocks like we had in Amazon the other day. That has to be compensated by other stocks, and then we get these whipsaws up and down. But as long as the market doesn't break significant levels, then the market is not in trouble. It's just individual stock that's in trouble. Okay, so Amazon might sell less, but I don't know, Kroger will sell more. So there will be adjustments, and while these adjustments take place, this is the sort of behavior you get. But just like, you got that kind of behavior here, that when it breaks, it just does a 3, 4, 5% up. I still believe that JP Morgan is right, that we're going to get around $205 expectations for earnings for the S&P as a whole. As soon as you get that, times that by 22, and you get 4500s, 4510, 4520. We will see it at some stage. In the meantime, very clear levels. You cannot be bearish on any kind of a basis below while the market is above 43.8463. It's just suicidal. As far as tech is concerned, I really wouldn't make much of the market reaction after the earnings for the big FANG stocks, the Apples, the Googles, and even Amazon. The market held in remarkably well, okay? Remarkably well. I expected worse in terms of, I wanted to see the reaction. I wanted to see a reaction lower, but I expected a much bigger reaction lower if the market was going to go lower. It's what I keep on saying. If they just rebalance away from some big stocks into some smaller stocks, and you just get some internal rotation within a sector, you don't go very far. You can see how basically this 15,000, let's call it, level has been a magnet. It goes slightly above it, slightly below it, back to it. While this is happening, this is just rebalancing inside the index. You can't expect big moves. And even if you have a look at the Dow, this was the previous highest close at just over 35,000. If all you do is you go sideways to it, that says that not much is going to happen here. And you really, in the Dow, you cannot be bearish unless you get a close below 34,200. I mean, you just can't. There is just no point. I've been asked to do some Russell as well. And this chart in Russell is the 195-minute chart of IWM. Really, we have been going sideways literally since, what is this? This is the beginning of the year. While the S&P is up, 17% for the year, the Russell is up a couple of percent. So we've had a massive outperformance in the S&P versus the Russell. It's going sideways, and the levels are very clear. It just cannot break and close below 211. To get bearish, you need to get several closes below 211. And basically what this market is saying is just going sideways. We'll have a look at it again on spreads later, but I really wouldn't expect very much from this market, even over the course of the next couple of weeks before Jackson Hole. For you who look at it longer term, this is a chart of SPY over IWM, i.e. SPY over small caps, over Russell. Well, it's gone back. I mean, this is a very long-term chart. This goes all the way back to 2000. And you can see that really in, let's call it modern times, between the great financial crisis of 2007 and 2008, and to date, and this is the coronavirus episode where small caps got absolutely killed, it's now back to where it was just before coronavirus, and basically at the top of the range where it's traded since 2005. So these 6-7 months of sideways action in the IWM have basically corrected this panic that we had at the beginning of the year to get back into small caps. And after the coronavirus episode. And really what it's saying is that for those of us who look at it longer term, it's probably not a bad time to allocate some money away from the bigger companies to the smaller companies. That is never really bearish for stocks, is it? So as an asset class. So there you go. You are at levels where basically over decade, 15 years, it's paid to allocate money to small caps away from big caps. Another interesting chart and completely consistent with what is going on in the market is XLF over SPY. This line has been here for years. We are right back at where we started the year, and B, when we got the bond market breakdown. This to me indicates that the market XLF is waiting for Jackson Hole, waiting for the Fed. It has gone back to the swing level, and it's now going to spend a couple of weeks of indecision here before it starts its move. And if it anticipates the move, that is the way that bond yields are going to go. So I will be following this ratio XLF over SPY very closely over the next couple of weeks to see if it gives me a hint to which way bond yields are going to go. If XLF starts outperforming SPY, the odds are bond yields are going higher. The interesting markets, the ones that are going to give us a really good clue about which way equities as an asset class go, are at the moment EEM and Nikkei. Now, to me, 26,910, which is also where the highest level of December of last year, are absolutely pivotal. I mean, let's face it, why are we going nowhere? I mean, the IWM and Nikkei are within a couple of percent of where they closed the year. while SPY has done very well, DAX has done relatively well, Europe has done relatively well. What is that telling us? And the answer is, I don't know. On a daily basis, on a weekly basis here, we keep on closing below, below the Bollinger Bands. This red line here is the Bollinger Bands, and we keep on closing below it, indicating pressure. On a daily basis, we're also making a series of lower highs, lower highs, lower highs. And really what I want to see is a higher high at some stage that says that Nikkei will start leading again. And why am I saying that? Because also we can see from the chart of EEM that we have a potential that we did all that we're going to do, because we just about touched an ABC down around 100 points, and which coincided with this 50-23, which I keep on saying is so important. But also we have a chance to go back down towards 48 and say that that is the low. Could very easily be that we need to see a couple more lows in EEM. But what is interesting is the EEM spreads, and this is EEM against against Nikkei. You can see how tied together EEM and Nikkei are. If we need to make another couple of more lows in EEM, then Nikkei will follow it and probably break that level that I showed you. And then we probably can get to a bottom. You can see how we have broken down slightly against FEZ, which is the European market, but we're still above this very important swing level 107. If we keep on staying above it, that will indicate that we are bottoming in EM, that we are bottoming in Nikkei, and that gives me more confidence that at some stage the whole of the equity sector will go higher. Whether it's led by SPY or not is neither here nor there, but then the whole of the equity sector can start trending up. At the moment, we're not really having a trending market. We are having a relative market where the emerging markets and Japan are really lagging, doing nothing or going down, while SPY is holding its own and making new highs and coming back and filling and so on. Not a trending market. What we need to see is these relationships stabilize, and then we can have a trending market. How much more? Maybe a little bit more of this move, as I showed you last week. We probably need these markets in EM and the Nikkei, and we'll go back to Nikkei to make, get people panicked around the 26,000 level, and then probably the BOJ steps in and we just go smack and start making new highs. That is the kind of thing that worries me, because I think that EEM and Nikkei probably have another big low in them, and that would indicate that on a spread all the other markets are going to go either sideways or going to have a little bit of a dip themselves. But we have very clear levels and we know what to do. I am really looking forward to buying. I mean, this could be an ABC back down to around, I don't know, somewhere mid 25,000s. But I think that will be the big opportunity going into the fourth quarter of this year. That these markets that have been the weakest over the first 6 months are going to probably be the strongest over the last 6 months. And that would indicate to me that the coronavirus 18th wave panic is over, when Nikkei can start making new highs, when EM can start making new highs. And with that, very little change really in the summary table and my biases. I think the risk reward is to be slightly short in European bonds with very clear stop levels. And SPX, really, these are, below 43.88, 43.84, you could get a move down to 43.18. I doubt very much that the market can go any lower than that because of the earnings mathematics. The resistance is around the 44.60 area, and I'm convinced that at some stage over the next couple of months we get to the 45.10 level that the math says is consistent with earnings. All the other levels are in here. I really don't see that unless we get VIX above 20.05 that there can be any sustained pressure on SPY. We keep on failing to get down up above 20.05 and staying up there and closing up there. Unless we get 2 or 3 closes up there, the odds of sustained pressure on SPY is almost nothing. Nikkei is the one, as I said, is going to be interesting, because if Nikkei and EEM stabilize and start making new relative highs on each wave, then that will tell me that the whole of the equity sector can start trending. Until that happens, it's just a relative move and nothing much. You're not going to get 5-6%. You're going to get 1% moves, 1.5% moves in each one of the US markets. Gold still frustrating. I think it's more likely to come down to 1765 ahead of Jackson Hole than bust through 1830, 1850. And you know what my view is in the dollar. I think if it comes down to 91.41 now, it's going to be a good risk reward buy for a move back up towards the 93 level. Thank you very much indeed, and have a great weekend, and I will tweet you on Monday.